Hi, Larry Gaines, PowerCycleTrading.com. I want to show you a trade setup and how to make it adjustments. And what I like to use is kind of the option delta. So the option delta helps us to look at the probabilities of a certain price being hit. So the first thing, this was an Amazon trade that we set up last week right here on the 25th for a break higher. And we did this with a call debit spread and then adjusted that on the same day to a long call Condor. So today we then adjusted it one more time because we had profit in the short strike and we used the 20 delta to reset the short strike of the new spread. So let's just kind of review the trade. So if you look at Amazon here, you can see from this high to low back in October to the low here, we now cleared that 382 retracement. So that's very positive. We cleared the 50 simple moving average and we're coming into this descending trend line. Okay, so it's just kind of stopped there today. Now we have price action support here at 32 resistance, at 32.50, and that trend line coming in right there. And then the next target after that would be the 618 at 3,300. So the first thing I do with any trade is, we look at the pattern, see if we like the trade. That's one of the big major steps, the pattern. And then the other major step is to do what I call price target mapping. And so mapped out the potential targets to the upside and downside using a combination of different things. And then we'll set up the option spread. So this trade was originally done as a call debit spread. Then we converted it on the same day when it spiked up into the close into a call Condor. So let's take a look. So in summary, we set the trade up on the 25th, call debit spread, and then on the next day it spiked up as actually the 27th. We converted to the first call Condor, and then today did an adjustment, taking some profit and adjusting it to using a 20 delta short strike. So let's walk through that and how that works. So trade one was on the 25th. We set up right here, the 25th, did a call debit spread, 31.95, 3,200, $5 wide, $1.93. So right here it was trading right around, right in here around 31.85. All right, so $1.93. So max risk 193 to make potentially over 307. So nice positive risk ratio. But then on the next day, on Friday, when it spiked up here, converted it to a call Condor, and a couple different reasons why. First, reduces our risk, and second, will also reduce our theta decay. So we sold then the 33.40.45 bear call credit spread, brought in $70 credit. So that drops our risk down to 123. And now look at our theta. We've got a positive theta of $19. So if it just sits here, we're just getting paid while we wait. Now, this was done based on a short strike. At that time, the 33.40 was a 20 delta, and now let's take a look and you can see how far it's fallen off on the delta. So on last week on Friday, when it was trading about 32.15, this 33.40 strike right here, that was a 20 delta. So that's how I selected that as the short strike. So then we set that short 33.40, and then so did a bear call credit spread selling the 33.40, buying the 33.45. You can see that that's currently at 50. Now this morning earlier when we had that pullback here, closed out this short call credit spread here, bought it back for 20 cents and made $50 profit. So that then adjusts down our long dated. Let's take a look. So this morning bought the 33.40.45 bear call credit spread back. We'd sold it for 70, closed it out at 20. So that gives us a $50 profit. Now with that $50 profit, what we do is that will then adjust down the cost of the call debit spread from the 31.95.32. So that will go down. We adjust that because we're going to keep the trade open. So that goes from 193 less the profit here of $50. So now we've got a adjusted price on this debit spread of 143 or $143, and then we sell a new bear call credit spread with a new, with the short strike at 20 delta. So let's take a look at that. So now we've got the adjusted price on the 4 December call debit spread, the 31.95.32, adjusted down to 143 from the $50 profit that we took on the original short credit spread, and then turned around today and sold 4 December, same option series, this week's expiration, the 32.85 bear call credit spread. And now at that point in time of today when we executed the trade, this was a 20 delta short strike. So we did that. It was 70 cents, currently at 80. So let's take a look at the deltas. So when we set this up this morning, or midday, this 32.80 short strike was a 20 delta. Now the market, it closed up a little bit higher today, so that delta has increased. And you can see here, if you're doing that right now, you'd be looking to sell this 20 delta here, which would be the 33.05. But what this tells us is if you look at use option delta, it basically, one way you can look at it is if you've got a delta of 20, you can see here, this is probability out of the money. So the probability that that Amazon this week would close below right now 33.05 is over 80%. So 20 delta means there's a 20% theoretical probability that it could get to 33.05, and the other way to look at it is there's a probability of over 80% that it will close below 33.85. So if we look at the 32.80, there's now a 27% chance that it could get there. But this trade looks good, and let me show you what it looks like now. So here's the beauty of this strategy. So now you can see this is what we call a call condor. So long call debit spread, short a bear call credit spread here. So this trade, we've got now current risk of only $73 of risk. So if everything fell apart, that's the max we could lose. And look at the theta. We've got now a positive theta of $13 a day. So if it sits here all the rest of the week, we're going to be collecting over $13. Now today it went out at $144 at the close. So $144, that's our potential revenue profit right there on the risk of 73. That's not a bad return. That's 197% return. All right. Now, if we come in tomorrow, let's just put here on tomorrow's calendar, the 2nd, this will be up, if it's sitting right here tomorrow at 32.20 on the open, this will be up $157 on the risk of 73, and that's a 215% return. And then if we take it to Friday expiration, on the 4th, and we come in here and it's trading right here on the open, we'll be up $233 on $73 of risk, and that's a 316% return on our risk. And at the close, if it closes between our short strikes of the spread, this trade will make $427 per spread on the risk of 73, and that would be a 585% return. So you can see the beauty of this, and just these adjustments based on delta is very important to understand. So if you like this type of trade setup, make sure to join us at powercycletrading.com, and you'll learn a lot about these strategies, plus how you use support resistance and directional trading. Okay, good luck trading. I'll talk to you on my next video.